A second rate cut in 2025. What changed and why? On October 29, 2025, the Federal Reserve announced that it had lowered its benchmark short-term interest rate by 25 basis points, bringing the target range to 3.75% to 4.00%. This marks the second time this year that the Fed has trimmed rates. But the decision isn't simply about cutting rates. It's about navigating a complex set of economic conditions, including a labor market that shows signs of cooling, inflation that remains above target, and the additional complication of missing economic data stemming from a government shutdown. What prompted the move? Several threads came together to push the Fed toward this decision. Softening labor market. Though unemployment remains relatively low, recent job growth has decelerated and recent private sector reports show weaker than hoped employment gains. The Fed itself noted that job gains have slowed this year, and the unemployment rate has edged up but remains low. Elevated inflation but less severe pressure. While inflation remains above the Fed's 2% target, it appears to be moderating rather than accelerating. This gives some room for subtle policy shifts. Data disruptions. One of the more unusual aspects of this cycle is that the U.S. government shutdown has severely disrupted the release of key economic indicators, including jobs and inflation reports. With official data delayed or incomplete, the Fed is forced to rely more heavily on private sector indicators and judgment. Risk balancing. The Fed's dual mandate, maximum employment and price stability, is under strain in different directions. On one side, employment risk is rising. On the other, inflation remains above target. The Fed signaled that downside risks to employment have risen. In short, the economy is showing signs of stress. The Fed wants to support growth and jobs, but at the same time it must keep inflation under control and cannot signal a full pivot until more clarity emerges. What changed in the Fed's statement? With the rate cut came a new policy statement and some subtle changes in language and signals. Among the key shifts, the Fed explicitly acknowledged that downside risks to employment have increased, reflecting its growing concern that the labor market may be weakening. The statement reaffirmed that the Fed would continue to carefully assess incoming data, the evolving outlook, and the balance of risks when considering additional adjustments. Importantly, the Fed signaled caution. The statement and the chair's remarks emphasized that another rate cut is not a foregone conclusion. Chair Jerome Powell said that although the committee opted to cut now, strongly differing views about how to proceed in December remain. Also, the Fed announced that it would pause or stop its balance sheet runoff, reverse quantitative tightening, as of December 1st. By halting the reduction of its holdings of Treasury and agency securities, the Fed is loosening its policy stance further, albeit in a subtle way. These tweaks signal that the Fed is shifting toward a slightly more accommodative posture, but doing so cautiously and without abandoning its inflation fight. Financial market and global ramifications. The Fed's decision and signal ripple beyond U.S. shores, with implications for bond markets, currency flows, and global trade. Bond markets. With the Fed lowering rates and pausing its runoff, yields on shorter-term treasuries fell, the yield curve shifted and markets began to price in further cuts in the coming months. However, the uncertainty about how many and when cuts will come added volatility. Foreign exchange and global flows. The expectation of U.S. rate cuts weighed on the dollar, and markets also awaited developments in U.S.-China trade talks. One commentary noted that major currency, bond, and global growth dynamics would be shaped by the Fed's decision and the U.S.-China dialogue, as stated by the Wall Street Journal. Global central bank interplay. With the Fed cutting, other central banks around the world, for example in Canada, Japan, Europe, are watching carefully. Some may delay tightening or cut themselves in response to weak global growth. Business and consumer impact. Lower interest rates mean cheaper borrowing costs for credit cards, mortgages, business loans, and auto financing. This can support consumer spending and business investment, which is exactly what the Fed is hoping for in light of the softer job market. Why this cut matters, and why it still matters. This rate cut is meaningful for several reasons. Recognition of labor market risk. By cutting, the Fed is effectively saying that the risk of a cooling labor market has become sufficiently large to take preemptive action. That marks a shift from the earlier focus primarily on inflation. The data fog complicates policy. Because the government shutdown has delayed critical data releases, the Fed must act with less clarity than usual. This raises policy risk, both in terms of mistiming and over-underreacting. Forward-looking messaging. The Fed is sending the message that while this cut is happening, it is not embarking on a full-scale easing cycle yet. It wants to keep its flexibility open. Global spillovers. In a world of already low rates in many countries, what the Fed does affects global capital flows, commodity prices, currencies, and emerging market borrowing costs. Implications for borrowers and savers. The cut means lower borrowing costs, which helps borrowers, but also lower yields for savers. It signals a modest stimulus to the economy, albeit one calibrated to avoid reigniting inflation. What to watch next? Looking ahead, there are several key developments and data points that will shape how this policy cycle unfolds. December Fed meeting. While a further cut in December is possible, the Fed emphasized it is not guaranteed. The minutes and chairs remarks suggest the committee remains divided and cautious. Labor market data. Once the government shutdown ends and data resumes, key indicators, unemployment rate, non-farm payroll gains, jobless claims, will be closely scrutinized. If job growth picks up unexpectedly, the Fed may pause further cuts. The converse is also true. Inflation readings. The Fed watches inflation and inflation expectations closely. Should inflation accelerate again, the Fed may hesitate to cut further. Economic growth signals. GDP growth, consumer spending, business investment all matter. A sharp slowdown may push the Fed toward more cuts. A rebound may tilt it toward holding. International developments. Trade policy developments, especially U.S.-China, global growth trends and foreign exchange pressures all feed into the Fed's assessment of the external environment. Market expectations and communication. The Fed's guidance and clarity will affect how markets price future moves, including the timing of cuts, the size of cuts, and the endpoint. If the Fed signals strong commitment to easing, markets may overshoot. If the Fed signals caution, markets may retract. In the coming months, all eyes will be on the Fed's next moves, and the economic signals that inform them. The balancing act remains real, supporting jobs and growth, while not undermining the credibility that inflation will be brought back toward the 2% target. How well the Fed navigates that balance will be a defining feature of policy in the remainder of 2025 and into 2026.